Hello and welcome back to our Business Tips. Michael Lapede here to talk to you about some tips on financial projections or financial forecasting. Very similar. Financial projections are vital tools that help business owners maintain and run a healthy and sustainable business, right? Knowing where your cash flow is going to be before you run out or have cash flow problems or shortfalls is very imperative. When business owners fail to make financial projections, they run into some very serious trouble. You need your financial projections for business planning, budgeting, and securing funding. So if you need to borrow money or you need investors or you need injection of capital, you're going to need forecasting, you need budgeting projections anyway. So you might as well have it not only for yourself to be a better business owner and be better in your business and better finances, but also you're ready for any borrowing of capital or lending or investing. Okay? Without financial projections, you're basically leaving everything up to chance. Here are some tips in making financial projections. We're going to kind of go through the steps, actually. So first of all, we're going to determine the purpose of the financial projections, right? Is it going to be for my business plans or is it to secure funding? Now, I always like to say there's worst case scenario, best case scenario, and you're probably somewhere in between. So sometimes it's three different scenarios that you're projecting, right? But determine it is, again, is it for decision making internally? Is it for outside financing? What is this for, right? And then you can determine what information you might need and if you're going to do the best case scenario or your middle ground one for yourself and so forth. Gather historical data. You need the historical data to project forward. That's the whole idea, right? Have the relevant data you need on hand. Past income statements, balance sheets, cash flows, whatever you have from the past is going to help you indicate the future, and you're really going to go line by line, right? So then you're going to start with the revenue. You're going to estimate your revenue. Determine all your potential sources of income and look back and say, okay, this is what I'm projecting for these sales. This is what I'm projecting for this income, right? And then you're going to determine your expenses. Same thing. Okay, last year I spent this much on marketing. What do I anticipate this year? I'm going to set a budget for da-da-da-da, right? And then next year it's going to go up, you know, and things will go up because you got to consider inflation. You got to figure your growth and your scaling of your business. So a lot of your projections are going to go like this, right? And you're going to have your cost of goods sold. So we have our cost of goods sold, which will be directly from the income. Right, so if we have our revenue and we have cost of whatever it is to make that, so let's say you're selling shoes, well, how much does it cost you to either build the shoes or import them and get them here and, you know, buy them and get them here, right? Either one. And that's your cost of goods sold, right? And then plus the labor potentially that's included in there. And when you're using estimate, when you're estimating all these, prepare it based on monthly. Okay, you can summarize it, you know, quarterly and annual, but you should do your projection monthly. You should break it down by monthly, and you can project profit losses, right? Profit and loss or income statement. That's income, cost of goods sold, and expenses and profit. You can also project balance sheets, which is your assets, liabilities, and of course your equity. And then we can project cash flow as well, which has everything that was kind of there based on timelines of when you're going to get your receivables in, when you're going to pay your payables, and when money's going to actually flow. Now, if you use a software, such as the one we use called Fathom, you can import, you know, you do your balance sheet and your income statement projection, and then it kind of just comes out the cash flow once you do the timelines on it. So they all really do tie together. All three of the projections tie together. Prepare your financial projections using different scenarios. Like I said, you're optimistic, you're likely, and you're pessimistic, you know, the best case, worst case scenarios, and in between. And that way you're prepared for any option. I really do like that. And lastly is don't forget to review them regularly. Review your forecasts, your projections regularly, and check them against the actual numbers and make any adjustments. If you're projecting, but you're not comparing your actual to projected, you're doing yourself a disservice, because how do you know if you did a good job projecting or if you're even on track? And you need to make adjustments as you go. If one category is way off, you need to adjust that category in your projection. So very important that you monitor actual versus what you projected. Any questions, we'd love to hear from you. Thanks for being a part of our Business Tips, and we'll see you in the next video.